one of the most important things, again, I was talking about the importance of keeping momentum going. One of the worst things you can do is have people in your company who can't meet the diligence requests. And again, that goes to what we were saying earlier about it being a war and not a battle. You need to be prepared, because when someone all of a sudden knocks on your door and says, I'm interested in buying the company, okay? You've got a window of opportunity, and those windows can sometimes close, like with the financial crisis, okay? So what you want to do is you want to, if your back office in your company is a mess, then you're not going to be anywhere near prepared when the moment when all of a sudden fortune smiles on you. So you want to have decent corporate governance, because when someone says, okay, you know, send us your numbers and we'll do a deal, if it takes you 6 months to do that, forget about it. If it takes you 3 months, you know, forget about it. So I think in a lot of ways, lawyers are the unsung heroes in a lot of ways, because their turnaround time has a huge impact on your ability to close the deal. And one other thing, quickly, just some general factors. I think if you're thinking about selling a company, you should keep in mind certain characteristics that are in general that they look for. So you want to have strong local market share. You want to have you want to be at break even or profitable. There's a few times that you don't need that if you're like at some web-based companies that can show exponential growth, you can get around that. But for the majority of companies, there's a lot of entrepreneurs who do new market companies, old economy companies. You'll want to show that you're profitable or at break even. Because when a company is coming in to acquire you, what they're very often looking for is growth. So, there's not a lot of growth in a lot of sectors in the US.
And synergies.
Yep, and synergies. So think about the world right now. There's not a lot of growth in the US in a lot of sectors. There's not a lot of growth in Europe in a lot of sectors. And there's some growth in certain countries in Asia in some sectors. But where there's a lot of growth is Latin America. So you put yourself into the mind of the acquirer, okay? I'm a large public company. I want to increase my numbers. Why am I going to buy a company that's not profitable, which are going to push down my numbers, and then the analysts are going to punish me on Wall Street, right? They want to buy growth, and we're in, like I said, there's never been a better time to be an entrepreneur or owner of a company in Latin America now. So they're looking at these growth curves here, and they're, the envy of the world. And so what happens is they'll want to acquire you, but if all of a sudden they see this big, hole of losses, they're going to say, oh, well, if we buy these guys, it's going to push down our profitability, so we're not going to do that. So you want to try to get to break even or profitability as much as possible.
The other thing, just being more specific on the process itself, is that along the diligence period, it's very important that the company gets really well organized to provide the information and is responsive, is very transparent. So if there are problems, it's very important that you bring them up front, that you tell them, okay, you're going to find this and this and this, and these are the reasons. Because exactly as Simon was saying, the bad thing is when you get those surprises and you go down, and if you are transparent and you say everything up front, you build trust and credibility exactly with the buyer.
And you also disarm any potential criticisms later. It's like what happened with Obama when he was running for president. He said, oh, I did cocaine once when I was in college. So now what happens? Through the election cycle, all those people that were holding back onto that, waiting to say, aha, we got you, you did cocaine when you were in college, they couldn't use that against him. Why? Because he disclosed it up front. So if you say, look, we have this lawsuit, we have this former employee or investor or partner, this is what happened, and because of that, this, then the person, it's not a surprise, you're calming them to the problem, and they're going to feel much more safe and secure and not surprised.
And also the other thing is that showing that you are organized in that process really reflects on how the buyer has a perception on how you're organized as a company. So organizing that diligence, providing information in a timely fashion, or giving some predictability of when you'll be able to deliver certain information is all very important. It all reflects on the perception that the buyer is going to have of your company as a whole.
And the question from Mariano related to sort of valuation. How did you, in your process, decide that what you were being offered was enough? I mean, I know you spoke to it a little bit, but in your mind, what was sort of that emotional process to say, okay, that's enough? I'm willing to do a deal on that basis.
We knew at what valuation we would be trying to raise money, and that was our benchmark. So we weren't selling, but we were in the process of raising money, which is in a way similar. So it was similar to that, and there was this equity component that made it potentially more interesting. Of course, it's a bet. So again, it was basically that and some other potential deals that we could do. There was some technology that we could have sold to Adobe, blah, blah, blah. But we already had a benchmark of how much the company would be worth. And again, it was just projections, yeah.
Mariano's mentioned a couple of times that you took a combination of stock and cash and equity in the acquire. I guess, you know, from Simon and Veronica's perspective, is that common? Is that something that entrepreneurs should?
It's a private company equity, which is more risky, right?
Typically, if it's a strategic buyer and he has no presence, he'll probably want to keep the management. So it's very typical to ask, you know, the top managers to stay on for 2 to 3 years. If it's a local company that is just, you know, buying in additional market share and is looking for synergies, then it's more likely that, you know, they'll keep some of the key people, not all of them. So that really varies on who stays or not.
A quick question for Simon related to that. One of the tensions that I see over and over again when there's cash and equity is, you know, is this equity being paid as sort of consideration to purchase the company, or is this, or really retention? Because if you're sort of giving the retention for free, what do you advise entrepreneurs you're working with?
You know what's an even worse problem? You know what's an even worse problem? Milestones. Milestones is even more insidious problem because you never know whether the milestones are really to make you feel better. Could they put you in terms of an earn-out? Or if it's an earn-out, exactly.
We're talking about an earn-out where
exactly.
Your purchase price gets.
That's where it's really, that's a good trick here.
Because and I couldn't agree more, because in many cases, because the human capital in the acquiree and the target company is so valuable, you know, the buyer says, okay, I want to buy into that, but I want to make sure that those key clients stay in place and that the growth that they showed and therefore the multiple that we're paying for is really right, so that that growth continues. So one way of doing that is exactly putting in an earn-out or tagging the price to future performance. And for the entrepreneur, the big issue in that is that, okay, I'm selling you, you know, for what I am today, but you're paying me with the money that the company will generate from the sales that I will help generate. So, you know, that's not fair. So in that sense, I would say that the best thing is to keep, you know, for the entrepreneur, probably sell a bigger chunk, but still keep some of the equity, so that, you know, he could still meet those targets, but he can have also upside and some liquidity if he stays on board for a couple of more years. So say, you know, so you sell 80%, you still keep 20. You could have those milestones, but you also gain, you know, additional equity appreciation from having a put call provision for the next 2 years.